Welcome everyone to the Vested Interest channel. This is Shane. This is our weekly portfolio update video. The portfolio currently does sit a little lower than last week, $442,395. We have seen some pullbacks, well, outside of really the tech sector, and even some of the tech companies right now. Meta is down. Some others have pulled back a little bit as well. Not an overall market pullback, but a pullback in certain sectors and certain positions. We did add $890 to the portfolio, so we will cover that in this video, what we bought with those funds, any dividends received, any options we received. And if you could, before we get too far into the video, if you could hit all of those buttons down below, it really does help out the channel. Hit that notification bell. Make sure you're subscribed to the channel. Share with anyone you think they might find value in the content. And watch the videos to the end. Watch time is one of the metrics that the YouTube algorithm looks at and helps push these videos out. So doing all of that really does help out the channel. Really do appreciate you and all of the subscribers out there. I do it because of you people. So if you could drop your comments down there and let me know you appreciate the videos, that would really help as well. All right, options. No options this week. We did put out a couple of options plays. Nothing hit, so nothing to speak of. We'll just move right on. Dividends, on the other hand, we did receive some dividends. That should say the 3rd there, not the 27th. We're not even to November 27th. I'm getting ahead of myself. On the 3rd, we received dividends from a couple different companies, $376.59 total. First one was Verizon Communications, paid us $262.90 in dividends. We do have the DRIP sets. DRIP stands for Dividend Reinvestment Plan. That just means anytime a company, ETF, index fund, whatever's in the portfolio pays out dividends, they get automatically reinvested back into the same position. I don't have to do anything. It's automatic. So in this case, the $262.90 went right back in and picked up 6.7467 more shares of Verizon. And then we had dividends paid out by AT&T, $113.69. Same thing, went right back in, picked up more shares of AT&T, 4.70534 more shares. And the new shares added by the dividends there added $23.84 in passive income over the next calendar year. Now, when you hear people talk about the dividend snowball or compounded interest, this is really what they're talking about. We already owned shares of Verizon and AT&T. Those shares paid out dividends. Those dividends get reinvested. Buying more shares, the new shares add additional passive income, which adds to that snowball. And the hill is the hill that snowball is rolling down is time. So the longer that I allow this to accumulate, the more dividends I will get paid out, the more shares I should have. And that is just the nature of dividend growth investing, which is why I like it, right? Eventually, I will utilize the dividend income to replace my regular income and pay my bills and to live off of. That's the idea behind the portfolio, never having to sell any of the shares inside the portfolio, just utilizing the dividends. And my plan, if you're interested, whenever I do eventually do that, is a 70-30 split. So 70% of the dividends I will live off of, 30% will go towards paying off the whatever taxes are associated, as well as reinvesting some of those funds as well. All right, we weren't done. We received more dividends from Owens Corning on November 6th, $57.38. Again, went right back in, bought more shares of Owens Corning, 0.52326, so fractions of a share there. Added $1.44 in passive income. We are adding to our Owens Corning position. This is one we were looking to add to in the month of November. And I'll be honest, this week, this one kind of fell off of a cliff, which, since I am in the accumulation phase, no big deal. It means I get to buy shares cheaper and actually below my cost basis for the first time in a while. So I'm going to take advantage of this over the next several weeks, at least through November, possibly into December if it stays pulled back, and try to get this position to over 100 shares. It's one of the few positions in my portfolio. I think this one, Union Pacific, VXUS, which is an ETF, the international ETF that I just recently purchased. So that's why that one's under 100 shares. But this is one of the few positions that is under 100 shares, and I would like to get it over 100 shares. So I am comfortable with the pullback right now and want to add to this one. All right, into the first new positions or new capital added, and the positions I picked up with those funds, $350.05 added on November 3rd. With those funds, there's the Owens Corning that I said I was going to be buying. We did add one share at $123.66. Again, I think by the end of the week, this was down below $110, $103, $104, somewhere in there. But we picked it up at $123.66 on Monday. Comcast Corporation, this one we've been adding to for a while. We continue to add 4 more shares to our CMCSA is the ticker there. Comcast is out of the communications sector. Owens Corning is out of the industrial sector. If I didn't mention that, AT&T is out of the communications sector as well, and so is Verizon. So if I didn't mention that above. But 4 more shares there to Comcast, $26.76 per share there. 4 shares to our VG, added to our VICI position. VICI Properties is a REIT out of the real estate position under $30, $29.84 per share. This $350.05 in the new shares added $14.24 in additional passive income over the next calendar year. We went back in pretty early. Usually I do my buys on Mondays and Fridays, but this week I've got a lot of things going on. I've been in and out of the house and with work and everything. So we went back in on the 5th, just a couple of days later, added an additional $540.38. With these funds, we added to the 2 ETFs I am focused on right now. Now, for VTI, it was one that I was adding to every single week. That one I am kind of backed off. I'm at 100 shares, a little over. And for that one, I want to be a little more selective. I feel like the overall market is a little overvalued right now. So I'd really like a big pullback on the overall market, 10, 15, 20%. I will be adding to VTI again at some point, but I'm going to be a little more selective right now. But SCHD and VXUS are the 2 ETFs I will be adding to every single week. In this case, I added 5 more shares of Schwab Strategic Dividend Growth ETF, ticker SCHD, at $26.63. I actually added a little more than this, but those went to my daughter's custodial accounts. VXUS, Vanguard's total international stock market here, 2 more shares at $74.42. There's Owens Corning again. Picked up 1 more share at $111.55, so $12 cheaper than I was able to get it on Monday. And Procter & Gamble, still down below my cost basis. Still feel like this one is a value. So added 1 more share to Procter & Gamble at $146.87. Procter & Gamble is out of the consumer staples sector. Now this $540.38 added an additional $18.23 in passive income because of the shares it picked up. Total invested $890.43. Total passive income added, the new capital as well as the dividends reinvested, $57.75. So very nice to see that continual passive income pile up. All right, let's run through the sector weights here. Communications makes up 8.38% of the overall portfolio. Consumer discretionary sits at 2.71%. Consumer staples at 7.61%. Energy makes up 8.81% of the pie. Financials at 6.52%. Healthcare makes up 11.6, or I'm sorry, 11. Yeah. Healthcare makes up 16.50%. I don't know why I couldn't spit that out and was getting the wrong number there. Industrials makes up 5.33%. Technology is now the largest slice of the pie here at 18.56% of the overall portfolio. Materials makes up 2.63%, and really the real reason for this right here, 18.56%, the real reason technology has kind of blown the doors open here in the last couple of weeks, getting close to 20% of the portfolio, is because of the run-up in Lam Research and Google as well. But really, Lam Research has really kind of become the main driver of the portfolio. Materials at 2.63%, utilities at 3.9%, REITs and real estate at 5.59%, and ETFs, which will eventually become the largest slice of the pie here, is at 13.45%. Over here to the right, you can see the same sector weight breakdowns, the percentages that matches up to the pie here on the left, as well as the dollar amount allocated to each position as well, or each sector as well. All right, here it is. This is my overall portfolio. I know it is a spreadsheet, but it is based on a real portfolio. I have shown that in the past. I'm not going to show it every single week. This is just easier for me to adjust and manipulate, and I don't have to get in and out. Plus, I can fit it all on one page and you can see it. So, and I do believe that it's important for those of us in this sector to show our portfolio so you can see that we are indeed in the market with you. We are not just talking about this. We are in the trenches building out our own portfolio, hopefully showing you out there that you can do it too. You don't have to be a financial guru or pay someone to do or manage your portfolio. You can do it with all of the technology we have now, typically at your fingertips on an app or on a computer there, on your cell phone or on your computer. Download an app. You know, there's a lot of them out there. Webull is not this one. I use Ally Financial, which is my bank. Most banks have them. You've got Schwab, you've got Vanguard, you've got so many different ones. M1 Finance now. Robinhood is an app. Webull is an app. There's a bunch of them out there. I think there's another one called Moomoo is another app. But most all banks have their own investing arm now. You can typically do it right through your bank. Like I said, I do mine through Ally Financial, which is where I have my savings and my checking account, and then I do my investing, my kids' custodial accounts as well. So I do most everything through Ally. But my Franklin Templeton is where I think my bank's through, or through my work 401k is through Franklin, I believe. So there's a lot of different sources out there that you can do your own investing. It doesn't really cost anything now. When I first got into investing back into the early 2000s, late 90s there, you had to pay a significant amount per transaction, and typically you had to go through a brokerage. You couldn't do it yourself, but that is not the case anymore. So hopefully those of you out there who are on the fence are watching, and you can understand that. Again, I don't have a degree in this. I don't have a background in this. It's something I'm learning along the way. Hopefully you can learn from my mistakes and not make the same ones. You are going to learn over time if you do get into the market. And if you're a little intimidated by individual positions, you can certainly start out with ETFs or index funds. Warren Buffett would recommend something that tracks the S&P 500. So if you wanted an index fund, FXAIX is Franklin's. VU has an ETF that tracks index fund. All of them have their own. Schwab's has some. Like I said, most companies out there have their own as well. So you can invest that way. You don't have to get into individual stocks. You can stick to the S&P 500 and do that, and take Warren Buffett's advice and just put away as much money as you can for as long as you can. All right, well, let's get into the overall portfolio here. All the positions in the portfolio here, total shares, and this is as of the close of business, yes, on Friday, but Saturday is when I got in and did the update. The current price of each position, market value here, average cost per share, and the purchase price. This does include reinvested dividends, so keep that in mind. Total return, whether I'm up or down, I am going to show you that. Percent return, same thing. Obviously, it's in the green, I'm up. In the red means down. And you can see biggest loser still is Comcast, down 27.65%. We're continuing to add to this position, but it is down significantly. Owens Corning, there, like I said, dropped off a cliff this week, 104.20. It looks like it ended the week at. So that one we'll be adding to. Occidental, same thing, down 12%. Pfizer down 9%. 5% for Procter & Gamble. That's another one I'd like to add to and did add to this week. SCHD, love this one while it's down. Going to continue to build that out. And Verizon is down slightly at 2.7%. So now biggest winners. Lam Research, like I mentioned, is leading the portfolio, up 117.96%. Google not too far down behind, up 76.93%. We've got some others. OHI up 48%, NextEra Energy up 45%. Johnson & Johnson is up 25%, Enbridge up 26%. So AT&T still up over 40%, 42.62%. Some of these others, I wish Vici would pull back. I want this one under $30. So I'd really love for this one to pull back below my cost basis right there. But it did momentarily. We were able to get it under 30 this week. $30. I'm sorry, my cost basis is $30.11, $30.34. Even under $32, I'll be buying Vici. So if it's not under 30, I'm still going to buy this one under 32. So even though that would be slightly above my cost basis, but 32.17 is under 15% of a 52-week low. So anything under 32 is a buy for me on Vici. What sector the companies fall in, whether they're a quarterly, monthly, semi-annual payer. We don't have any monthly payers right now. I may remove that column altogether. I've kind of balanced out my portfolio based on their payout months a little bit, so I get payouts every single month without having monthly payers. Whether they're a semi-annual, monthly payer, again, that's what these columns are for. The yellow highlighted means they've raised their dividend for the year. Yield on cost here, my portfolio weighting. So what you saw on the previous slide was each sector's weighting. This is each individual position's weighting. I do have a rule in the portfolio. I do not want any one position to be more than 10 to 15% of the portfolio, really 10%. I do not want any sector to be more than 20 to 25% of the portfolio. Really, I like to stick at 20. Now, if it does hit, let's look at the closest one, Lam Research, 9.84%, so almost 10%. That does not mean if it gets over 10%, that does not mean, which it may if it keeps running up, does not mean I'm going to sell Lam Research. It just means I will not add to it, right? I would add to other positions and eventually it would level back out under 10%. Same thing with any sector. If it goes over 20 to 25%, let's just say 25%, I'm not going to have to sell companies in that sector to get back below 25%. I just would stop adding to positions in those sectors, right? Google is the other one that's close at 8.73%. Same thing. I wouldn't look to sell shares of Google just to get under 10% if it does continue to run up. Dividend growth year over year. This does get adjusted whenever they adjust their dividend payouts. Payout months here. This is their typical months. I know sometimes companies that pay towards the end of a month or at the beginning of a month might slide into the next month or pay out a little early, especially whenever the payouts fall on a weekend like a Saturday or Sunday. And where the company sits at 15% of a 52-week low. Now, I use this column. I want my average cost per share to be below 15% of a 52-week low. All right, so Vici is a good one. Like I said, it's currently slightly above my cost basis, $30.34. My cost basis is $30.11. But I can buy it under $32.17 because that's under 15% of a 52-week low. So again, under $32 is where I like this one. I'd really love it under $30, under my average cost per share, but I can buy it up to $32.17. Really 32 I put a cutoff on, but that gives you an idea of what I'm using this column for. All right, total shares, 7,130.483 shares in the overall portfolio. Market value of $442. Market value of $442,000, $395.25. Purchase price, $372,614.44. Total return, I am up $69,780.81. Or 18.73%. Now, I've said this before. I say it on every video. I think I don't focus on total return. It is nice to see. But unless I sell all of the positions in the portfolio, I do not lock in this total return or the 18.73%, right? So it's nice to see again, but it's not the most important thing to me. It's not what I'm focused on because I don't plan on selling all my shares and then shifting gears later on into other positions. That'll cause a taxable event. So if you're planning on that, nothing wrong with that. If you're going to go growth first and then shift into income plays later, nothing wrong with that. But keep in mind, you're going to be buying at much higher prices, one, and two, well, I'll give you a few. One, you're going to be buying at much higher prices than they are, probably. Maybe they go down, who knows. Two, you are not going to get that compounded interest over time. And three, you are going to trigger a taxable event whenever you sell. Right? So you want to make sure you keep that in mind, what you need to set aside to pay those taxes. All right. Current yield, 3.009%. My yield on cost is a little higher at 3.572%. Portfolio weighting, 100%. Estimated annual income. This is what I focus on right here. Currently, $13,310.29. Total dividends, estimated annual income paid from all the different positions in the portfolio. Continues to grow week over week, month over month, year over year. Very nice to see. And that is a new record, $13,310.29. Going to be very close to getting over $14,000 by the end of the year. We will see if we make it. Dividend growth year over year at 5.33% on average. Again, it does adjust whenever we get different payouts, and they adjust their payout percentages. I'll adjust the dividend growth year over year, and then it'll adjust down here. All right, that is really it for this one. Hopefully you are having a good or had a good week in your portfolio. Again, some sectors and positions have kind of pulled back over the last couple of weeks, or definitely this week here. We saw some red in the market. Overall, the market is still very near all-time highs, but again, might be some individual positions in your portfolio that have pulled back. Let me know what's going on. What did you buy this week? Are any options you were in? What dividends did you receive? And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Again, drop a comment down below. Let me know what's going on in your portfolio. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.